So I am based in the city of London. This is my second career. I used to be in the film business. I owned a film production company, and I decided when I turned 32 that I wanted to sell my shares in the company. So I started the company. I ended up selling it to my partner, and really big thing. And back then, so this is 2008. It's not that long ago. I wanted to learn how to invest, and so I'd been reading a lot of Warren Buffett books and a whole lot of stock stuff, and I very much wanted to get into the stock market. And that was the beginning of my journey, and it basically got me to where I am today. And I've been trading for clients from 2014. So I started at around about 2009, and then sort of kicked off from there. So why I'm telling this is because, first of all, I come from what could be argued a creative background, and I find that that hasn't been a problem at all. In fact, I find in many ways that has actually helped me to trade, because I work with visuals, and trading, especially technical trading, is a visual activity. So one of the things I would encourage you to do is definitely track me down on YouTube. There's a beautiful weekly analysis content which I do, and also the weekly analysis I do, which is specifically for FXGlobe. And so you can really get a sense of how clean and clear technical analysis is supposed to be, and how reliable it is, and just to get a sense of that. So what I really want to do here, if I can help you achieve increased confidence in your analysis, that will then lead to improvements in your trading. And so the easiest way to do that is to just look, for example, at the last 3 or 4 weekly analysis videos, and you can see how reliably I can predict what the market is most likely to do. So I try to break this down. We only have an hour, so obviously trying to brain dump as much as possible makes it relatively tricky, because I could talk about this forever. And also you do have to you have to talk about it from different angles, because it has different, all of us are kind of relatively different in how we process ideas. And you might have to hear one person say it one way and another person hear another way before it actually makes sense to you. All right, so first of all, I want to talk about what is the definition of trend trading. What is it? Why does it work? Why does it work? How do we go about obviously implementing it in real life trading? Then we've got to talk about, the implications, unpacking the advantages and potential pitfalls of trend trading. What are the advantages, the disadvantages, examples, strategies and techniques. So revealing the methods top traders use to maximize trend trading. Obviously live analysis, where we're going to go have a look at the markets, and I'd love for this to be interactive. So please just don't be shy, just ask any questions you have, and Christina will relay them to me as we go. And I don't want you to feel that you have to hold them through to the end, because I don't want you to forget. So if it's in the moment, if you have a question, ask me anything, don't be embarrassed. Okay, so all right, so understanding trend trading, obviously what is trend trading? Well, it's a type of trading. So I'm gonna grab a whiteboard here so I can do a little bit of drawing, and I'm just going to zoom in, and I wanna kind of kick things off. Okay, so one of the most important aspects, and this is relevant to what we're gonna do today, is really quickly discuss the difference trading versus investing. Okay, so let's do this broadly. These are 2 different activities. Trading versus investing are 2 different activities. So I'm going to grab this, and let's just imagine, for example, that we're looking at a daily chart for the S&P. Okay, so we could trade, on the platform, we could trade the index. So let's just say, for example, we see it's trending up, then we see it shift and it's trending down, then we see it sort of going up, and then we see it sort of going down, and then we eventually see it start to trend to the upside. So very quickly, let's talk about investing. What is investing? And the why does this matter? Well, first of all, it's a different mindset, and it changes our decision-making processes. And those processes obviously can lead to different results, because they tell us when to get in, when to get out, how much to risk, how long to hold the position for. So really, those are decisions that are made depending on what we are wanting to achieve and what we think we should be doing relative to the market conditions. So we talk about investing. So first of all, investing is a passive activity. What do I mean when I say that? It is not something that requires our attention every day. It just isn't. It is something that requires we take action only at certain times of the year or certain times of the Our positions are usually held for quite a long period of time. So investing is with a spare bit of cash. We have the choice of putting it into investing it into property. We could put it into a high interest account. We could put it into stocks. We could put it into expensive bottles of wine. There are different ways in which we can invest our money into different types of opportunities out there. So with investing, it's usually spare cash. It's cash we don't need right now. We can afford to put it away for a long period of time. So usually at that point, this is a generalization, but at that point, it's burning a hole in our pocket. And our logic is the sooner I can put it into, let's use the example, stock market or an index, the sooner I can put it in, the sooner it can get to working for me. And so just go, look, if I put it in today, I'm thinking long-term, 3, 6 months, maybe 2 years or 5 years, as long as the sooner I get it in, the sooner it can start working for me. So we're not too worried about our entry. Once we throw it in, we have to then write out the good times, the bad times. The good times is that on a long enough timeline, it's going to go up in value. So first of all, we've established no real fixed entry price. Soon it happens. So Warren Buffett will be waiting for that exact price that he can get before he gets into the market. We're not going to worry about that. We put it in. The next thing that happens is we tend to want it to go up in value. So why is that important? It eliminates a whole lot of markets. It eliminates currencies. Currencies are not a good investment vehicle. They're one of the worst compared to all the other options that are out there, because currencies can go down and they can go up. Whereas when we're looking at money we want to put away for a very long period of time, we need one direction to win. So we need it to increase in value. So we're limited to certain directions, which limits us to certain instruments to trade. Then usually we don't really have an exit plan. So, excuse me, we don't have an exit plan. That means that as long as we don't need the money and as long as it's increasing in value, we're very likely to just get there. Okay, so that's very different from trading. Okay, it's very different characteristics. It means that we're going to select a stock over a currency. It means we will choose one market over another. Trend trading is incredibly powerful in trading because historically they tend to go up. They tend to move more than they go sideways. Believe it or not, there's this one of these urban myths is more than they move. It's not true, especially with the US indices. They tend to move way more than they do anything else. Excuse me, they tend to go up. And we'll have a look at this. So now let's talk about trading. So trading is a different activity. Trading is now having to earn a monthly sort of a primary or secondary source of income every single month. So that means that by the end of the month, we must be able to withdraw money to cover our overhead costs at the end of the month, which means in order to do that, we must have closed out banked profits, closed out those positions in order to realize the profits in our accounts and withdraw them our rent or pay towards our monthly costs. And so this from that, it means that we're probably looking at opportunities for the next few hours to the next few days. And then each week, as each week starts, we start from scratch. Potentially, we're looking at, okay, what are my opportunities this week? Because really what we want to do, there's about 4 weeks in a month. We want to ideally be building up our accounts and ideally making profit each week so that by the end of the month, we've got that. So what it means is we've got to close our trades. Those trades have to be closed. They cannot be left open. So when we're trading, we're looking at the current market conditions and we're looking at what's happening for the next few hours to the next few days. So it's much more granular. So here we might be going, okay, it's an uptrend. I see a nice bullish candle. That's a terribly drawn bullish candle. My entry is above the high, stop loss below the low. And I'm risking a percent of my account and I'm targeting, say, 3 to 1. So I'm targeting 3 to 1 on my average trading market is going. In other words, I need a setup that is very high probability. I want you to remember this. A trade is when we look at the markets and we look for a signal of what the market intends to do next, only its immediate next move. This is crucial. Once you can kind of grasp this and believe it and apply it, it will transform your trading. Our goal is to just identify what the market's immediate next intention is. Okay. So we're looking in this example, targeting 3 to 1. Then maybe we get another setup. We look for another entry and we head off. There's my little pooches looking to obviously get engaged in this webinar as well. And potentially we target that. Maybe we trail our stop loss, and so we get stopped out at a certain point. And in a way, I'm also talking a bit about strategy here as well. So it's a bit of a wax on, wax off moment. Then if the market changes direction, we wake up and it's next week and we're looking to sell because the market is looking bearish, and therefore entry and stop loss above the high. We're targeting 3 to 1, and maybe we come out with 1.5% on that one. So it's much more granular. We're trading in the trenches, and we're trading it whichever way the market is going. Is it trading upside or trading to the downside? And so what's different from investing here is we can trade in different directions. Our entry is precise to the pip. We have a precise entry. Our stop loss is usually in a very precise place. We are planning ahead of getting out of our trades. Every single trade has an exit plan. It either reaches a goal, a destination that you have identified ahead in terms of price, or potentially it comes back to a trailing stop loss and it gets stopped out. So your goal, really smart approach, is to have both an end goal, a target, a take profits order in the distance, as well as a trailing stop loss, so that whichever way price decides to go, you can capture profits. Okay. So that's very different, and those trades will absolutely close out. So I'm telling you this because this is how we become the problem in an otherwise to take a trade, and then when we're in the trade, we decide to convert it to an investment. We take away the stop loss because maybe we think in the long run, maybe the market's going against us. We don't want to lose the trade. So we take away our stop loss, we move it, so we increase our risk. We keep thinking that the market's going to come back and go in our long term and not short term, when in reality what has happened is that the market's conditions have changed, and we should have just closed out that trade and either changed direction or reassessed the trade or gone somewhere else. So trading creates our decision-making processes versus investing decision processes, and that we have to understand. So for example, let's just say that I own Tesla. I love Tesla. I freaking love it, man. I love everything Elon does. Let's just say that that's the case. So, but there's a bearish setup on Tesla. Maybe I'm trading Tesla during the day and there's a bearish setup on it. But my instinct won't allow me to sell it because I love Tesla, and selling it means that I don't trust what he's saying, or I don't like the stock or something. And so you get these emotional and mental conflicts. And so usually you won't do that. So even though it's clearly looking quite bearish, you will not do it. So this is very important that we also need to be neutral, and we need to understand all of these things. So, okay, one more thing as well is there are really only two types of, all right, this is really important. These are big concepts that we need to understand. There are only two types of conditions, or the I guess, or one that it can exist in at any point on any time frame, any market, any time frame. It can only either be trending, all right, up or down. So it's either trending, it's either moving, or it's not moving. So it's either range bound, which means it's usually mixing up its highs or lows, and so there's no clear party in control. The bulls aren't in control, the bears aren't in control. And so it's one of these two. So it doesn't matter which chart you go to, you check the time frame, it's either going to be trending or not trending. Excuse me. And so what's important about this is it really generally will limit the kind of actions that we could take on this. And there are, generally speaking, only three ways in which we can engage in the markets. So let's put the second one, the second best way to do it is to trade a range. So you sell at the top, put your stop loss above the highs, you sell at the top and you target the other side. It's a feasible way to make a living. You can do it. I don't think it's the best way, but it is a way. Part of the problem with this is that nobody's really in control. The volumes are often lower because when the market's moving, a lot more people engage in it, and that's part of why it moves. When it's not moving, most people who only trade trends, for example, will not engage in a sideways market. So then you can buy at the bottom and trade it up to the top. So you get in, entry there, stop loss on the outside, and you target just on the inside of the range, sure that you manage to get to that target. So that's trading ranges, and that's the second best way to do it. The third way to trade the markets is what's known as reversion to the mean. And now I feel like I'm going to sneeze. I really apologize. You're not getting the best version of me in this webinar, but I do apologize. I wanted us to have this webinar come hell or high water, and I didn't want you to miss out on it. So excuse me for 1 second. I'm just going to blow my nose. There you go. So the third option, dangerous way, which sounds like a great idea, but in practice is really not that great. It's called reversion to the mean. So the idea is that the market, when it's trending up, for example, will always correct. It will always correct, and therefore it will correct towards its true value. Technically true. However, in practice, it's very tricky to determine when it's going to correct. And also at that point, the idea is that you would then sell. So you'd put your stop loss here, you'd sell at some point here, and you would target where you would take profit. So this is a very tricky approach for several reasons. One is you're trading against the flow, all right? It's higher risk. It's actually what's called an inverse reward to risk. What does that mean? It means that you might risk 1% here for 0.5% profit. So you have a lot more losses because you're going against the trade. It's tricky to put your stop loss in a particular place. It's tricky to potentially know where to take profit. But it's called reversion to the mean, and it's very popular with the kinds of people who work in big institutions. They always talk about reversion to the mean. It's nice and complicated, and it sounds like, yeah, the market's always going to come back to its true value. So it's a whole lot of what we refer to as intellectual masturbation. It's a great idea on paper, but it isn't realistic for retail traders such as you and me to kind of take advantage and actually generate an income off the markets. Which leaves us with, generally speaking, the number one best way to engage in the markets is to do the opposite. So don't trade a range, don't trade against the trend, trade with a trend. Trade with a trend. Ideally, we'll capture an entry when we get a pullback. A pullback makes a lot of sense, and we're looking to then identify a particular profit. Okay, a place to take profit. So the most common reliable approach to doing this is to target what is known as target a 3-to-1 reward to risk setup, and to risk no more than, say, 1 or 2% of our capital. My recommendation for most traders in their first 500 trades probably, but at least in the first 100 trades, is about 0.5% maximum per trade. The reason for this is I don't have to skill up a lot. I have a lot of experience in the markets, and I have a lot of skills that I've developed over time, and I've learned a lot. So I don't spend a lot of my trading sessions still acquiring new knowledge, but most traders, before they get their first 1,000 trades under their belt, are still learning a lot of time. So your brain doesn't always know what's going on. You're not sure if you took a good trade setup. You're not confident. Was it a losing trade because I made a mistake? Was it a losing trade because the strategy doesn't work? Should I change strategies? There's so much going on before you settle down as a trader, which is really what I want to do here. I want to help give you some direction. I want to say to you, look, decide whether you want to invest or you want to take longer term positions. Decide if you want to be a day trader. Decide if you want to trade ranges. Decide if you want to trade trends. If you decide to trade reversion to the mean, understand why you'll have a lot more losing trades. When you do make money, your profits aren't going to be very big. Excuse me. Okay, so these are really important concepts, and this is being changed. Once I realized, and I learned this from another trader. So you always learn from other traders. Once I learned focus only on trending markets. What then happened was that I learned how to identify good trends. So once you decide where you're going to start to build your skill, then your eyes and your brain start to then build up. You decide you play a particular sport, let's just say baseball or golf, and then want to practice your swing. For example, in golf, there's a big difference between your drive, your long game, your short game. And if you decide, listen, I'm just going to focus on my short game for 6 months, your short game will improve, because what you've done is you've narrowed it down to a point where your brain and your body can now start to tweak and notice stuff. It's got less data that it has to process to improve, to be able to like digest that data and make tweaks. So when we focus on trending markets, that eliminates very stressful trading that loses a lot of money, that's not high probability, it's low probability, low reward. Then you do both of these. Now you can, but most of the reason most people want to do that is because they don't want to miss out on opportunities. But really the fact of the matter is that if we focus on just trading markets, we can usually find a market that's moving, it's less stressful, makes us more money, and we then know which way to go. Thank you. So we then know which way to go, and we can, it's less stressful, and then we can start to work, this is a sparkling water, then we can just decide where we need to go next. So if you don't, so a big part of what I've just done is clarify, are you trading or investing? And then it actually is almost irrelevant to a degree if we're trading which markets we focus on, as much as we focus on the market conditions. So there are certain market conditions, this is really important, that are easier to trade than other market conditions. So let me show you in real time. Let's go to the charts. That's a really, really good chart, man. It's trending, it's smooth, it's calm, it's got a clear direction, looks great. Let's look at something that doesn't really have much clarity. So what about this one? Okay, so this one's really choppy. We've got really choppy, prices kind of whipsawing all over the place. Do I buy, do I sell? It's just very, very messy. Let's look at a few others. So let's just go through a few of these. Let's have a look here. Okay, so even here it's very, very choppy. And I'm going to give you a very quick tip, very quick, very powerful tip here. If you look at the daily, no matter whether you're a day trader or a trader, a couple of things you want to do. Always look at the last 4 to 6 candles on the daily. Just look at the last 4 to 6 candles. What you're trying to do is, if the daily last 4 candles are kind of doing this in a row, it looks like this on the lower time frame, which means it's very choppy trading, which means for day trading purposes, it is not worth your while to engage in it. Okay, your goal as a trader over your journey is to become more and more comfortable with less on your charts. You can take things off, you can read by the end of when you become a candlesticks. You're looking at just support, resistance levels and candlesticks. Those are the 2 most basic things that we can trade comfortably off of. When we add moving averages on, or we add a MACD indicator, for example, we are giving ourselves a few, not too many, but a few extra indicators that help confirm what we're looking at, or just tell us green light, red light, green light, is it safe to go or not safe to go? So when we see that, it means that it's incredibly choppy, which means that it's not good for day trading. So if I go down there, it's going to be very choppy. If I go down to the 1 hour, for example, and I zoom out a bit, it's very, very choppy. It's not really worth my while. I mean, there must be better stuff out there. So what are we looking for? We're looking for something that might have a strong trend. So let's have a look. Let's just throw a few charts in here. Let them refresh. Okay, and what I am looking for alternatively is to see daily charts that are either doing this or this, and not too overextended. When I see that, if I go down to the lower time frame, I have a nice trend to the upside or to the downside. So let's go and have a look at that. Okay, so again, this is an example of what I want to avoid. So if I saw this now, if I was seeing that over here, I'd stay away from it. These are not really ideal. I want to just keep going until I find something that is clear looking for. So that's a nightmare. So that's a nightmare. This is not looking great either. So that just means immediately stay away from it. If I go straight to the 1 hour time frame, it's just it's a tumble dryer. It's just gonna a washing machine. It's just gonna kick you around all over the place. Let's look at US oil. Okay, so US oil's got a bit more of a trend happening. That looks good. If we go straight to the 4 hour, it's got a bit of a trend happening. That's just by looking at those last 4 or 5 candles together. Actually, I think I can do that. That'll work. All right. And so this is a really, really cool thing. Let's go back to the slides. How are we doing for time? We're halfway through. Okay. So it's a trading style. Trend trading is a but what I wanted you to take away from this is why. Like, why would I trade a trend versus a range? Well, because in it, it's safer. It has a higher probability of moving. Why? Because it has more people in it. It actually has a direction which it wants to go. And when a market's ranging, that's not a direction. That market is in a bit of a coma, doesn't really know what it wants to do, and therefore we want to wait for it to move. Okay, so we can obviously buy or sell, go long or go short. And then we've got swing lows and highs. So what are these? Swing lows and swing highs. By the way, can I do a temperature check? Is this making sense to everyone who's watching? Is this making sense? Are you finding this useful? Are you finding this helpful? So while I wait for you to answer, Christine's going to tell me about that, while I'm going to carry on here. So we can tell because the thing about a trend isn't a single move. That move up is not a trend. A trend is a series of moves. So you have to have a series. Collectively, the market is going somewhere. There are lots of people getting in and out on every level for different reasons. So think about it like this. If you're trying to sell your house, or you look at the property market in your road, for example, the property prices will either be going up over time or going down over time. So it depends on whether, let's call it, you're in a housing, or maybe a bear market where people are selling their houses. Now the thing is, you might be looking to buy or you might be looking to sell. That's a personal choice. It gets tricky because when the housing prices are going up and you're a buyer, price is a factor. You've got to, ideally, you want to try and negotiate a better price, or maybe you look for a house that you can afford. So when the market is going up, there are people that are getting in at these areas every time the market drops because they want a better price. That's what they're looking to do. And there are people that are panicking and buying at this point. So if you do a move like this, okay, there's 2 parts to this move. Oh, I did that terribly. Let's do it again. Okay, so the worst time to get in when any market is moving is, let's call it in the second half of that move. Second half of it. So in this second half here is the worst time to do it, because by that time a lot of the move has happened and you don't know how long it's going to go on for. And Nvidia is a great example, or any kind of a stock or Bitcoin. We can look at that, where it could go like this, or it could do this and come down. So how long it's going to go on for, nobody can predict. Nobody can predict. And anyone who says they can do that, they're talking bollocks, because what I mean by that is it could come up to here, but it could do this and then come down and then come up here. So when someone predicts it's going to go up there, do they mean in a single move? Do they mean in multiple moves? What do they mean? So no one can really predict that it's going to go 1,000 pips without taking a break. You can't do that. What you can do is say the next major level is up here, therefore price is probably going to go to the next level, because that's what the market does. The market looks at price levels, and if it breaks through this level, the next most likely target for it is going to be that level. Because before charts even existed, before we had charts, when we were just at the stock market, when it was just a ticker price, if you go back 70, 80, 90 years ago, 100 years ago, it was just a ticker price on a board. And so traders in the pit noticed that, when a particular commodity or a stock got up to a particular 10 or 50 or 100, it could battle maybe to get past that number, maybe come back down to 90 and then go back up to 100, but then when it go up to 110. And so before we even had charts, numbers were really that price level on the side. That price level is really what the markets do. And when they break through a price, they tend to keep going. Okay, for the most part, that's a generalization. It's not a hard and fast rule, but it's generally true. So the first thing we do as technical traders is identify these key price levels. We look at gold. Let's do it. Let's do it for real. Let's go look at gold. Excuse me, man, this is just, I apologize. Let's see if we've got a plain chart. No, okay, I'll just get rid of these, just delete that, just get rid of all this. Just get rid of all these things. So if you say to me, Adam, what's the most important stuff I need to be paying attention to? This is it. Let's look at gold over time. And what do we see? Especially if we look at it from a weekly perspective, we can see that certain price levels are significant. We can see, for example, if we come down here, especially if we start off with round numbers. So let's just put a line in at 1900, and let's put another one in at 2000, and another at 2050 or 2100 for gold. And we'll do another at 1700, just so you can kind of see, or 1800, I beg your pardon, there, and another one at 1700, just so you can see that generally speaking, we can see the market respond to round numbers. And so what we do when we look at a chart is, first of all, identify where those key numbers are. We don't need a lot. We look at where price is now, and we do 2 above and 2 below. That's all we need. The market is not very likely on the daily to go much higher than that. Then we go down to the 4-hour, and we can kind of see where these next major levels are. And generally speaking, they will go from one level to the next. So if we do manage to break through 2000, all through this number, and test it and reject it, we're next major level. Okay, so that was it. I want to talk about. So trend lines, moving averages, technical indicators, the simpler the better. Trading is not, trading well is about doing, or success in trading comes from doing the very basic stuff really well. Support, resistance, identifying a trend, identifying, identifying major candlesticks. Very simple stuff when you break it down into digestible chunks, doing those very well. Complexity. If you find yourself suffering from analysis paralysis because it's Elliott wave, but then 5 people who do Elliott wave is giving you a different, which wave are we in on a sub wave, like it's all kinds of things, and then they put their trend line in a different support resistance levels and so on and so forth. And then you're suffering from analysis paralysis because now you've got 10 indicators on a chart, and it's not helping. It's not working. It's about doing the basic stuff really well. Okay, so we've got moving averages, momentum indicators, trend line, chart patterns. Really simple stuff like head and shoulder patterns is a change in trend. Head and shoulders, there's the shoulder, there's the head, there's the other shoulder. It's a change from an uptrend into a downtrend. It's a very simple thing. And you know what? You could trade head and shoulders as a pattern. It has an 83.04% success rate, meaning that the next half of it, so the idea is that if you trade the neckline and you get in over here and you target that distance, 83 out of 100, but it's 1-to-1. It's not a bad idea, but it's targeting 1-to-1. So the point is that there are very simple ways. Most people want something more complex because it's more sexy and they get excited in a whole lot of stuff. But I'm just saying that if you really keep it simple and you don't overthink it, you'd be amazed. You could prove me wrong. I mean, or you could just find out for yourself. Go through the charts, find all the head and shoulders, see how many of them unfolded. It's very successful. And the beauty is you could do that in any market, any time frame. So you could pick and choose what you want to do. Okay, so yeah, we get lower transaction costs, enhancing portfolio performance, decision making. It's really interesting. I was talking to someone today about ARK. So Kathy Wood is a well-known investor. She's got a company called the ARK ETF for ARK Technology or ARK Innovation. But it's actually incredible from a technical perspective that they suck getting in and out of the markets. They tend to sell some of their best performers. They got out of NVIDIA at the bottom. They just caved, they got out of it, and it went on to become the biggest winner. And if they had just stayed in that one, it would have fixed all their problems. But their decision wasn't technical. Technical trading is very, very powerful. It's very powerful. So we can have a look at what's going on in the markets as well. Okay, so I've spoken a little bit about trading analysis. I've spoken about counter trend trading. Any of these indicators work very well. You've got RSI, CCI, you've got MACD, you've got Williams %R. So there's quite a few of these, and they're almost all very good for reading momentum. I'm going to talk about that in a moment, and really want to have a look at the markets. Okay, so what we're going to do here is we're going to do some real-time analysis of. We'll start with the S&P 500. We've got a limited amount of data here just because of the data on the platform, not a problem. And we'll just bring that in. Actually, you know what? Let's just get rid of this. I don't need this one. We'll do it this way. Let's go and have a look at these ones here. And if we look at what's going on now, so as a trader, potentially, and it pays. One of the things, so I have to tell you this. I mean, this is one of the biggest journeys that I went through in my experience. And every single person I ever talked to, most people go through the same journey. First of all, we sort of start tinkering on our own. We watch some YouTube videos. We get into a few forums. We chat to a few people on a few chats. We've got a Telegram group. And the problem is that most of the people in the group, most of them, not always, but most of them are all at the same level. Nobody's really cracked the stuff, because most of the people who have cracked it are either spending a bit more time are teaching, and there are some phenomenal teachers out there. I'd like to think I'm one of them, but there are some incredible people out there who want to. It's a hobby as well as a job, and so but they're not necessarily wasting their time in the forum, going down rabbit holes, and they might be producing YouTube videos and so on. So the thing is that it's not really necessarily a great place to get settled. And also you get a lot of incredibly negative people who've revenge traded and blown their accounts, and then they just tell everyone else there's no way you can do this and you can't do it, and they want to drag, it's called crabs, and want to drag other people down. This is very common, especially in this. A lot of people who lost their money on cryptos, and they went down a crypto rabbit hole and they've lost their money on it. And this is not what we do when we're technically trading. Again, the market gives us very clear signals as to what's going on there today, ladies and gentlemen. The media is incredibly negative. It's ridiculous. The markets are actually doing really well, and there's this insane conspiracy, and like compared to 20 years ago, the amount of conspiracy stuff that happens, it's absolutely insane. So don't worry about science, this isn't happening, this is all a lie. And I'm like, okay, and it happens a lot, and the problem with that is it's very paralyzing for people. So the journey that I went on was, I remember listening to the news. I would listen to the news and I'd be in the forums, and they'd always be saying, back when I was learning how to trade, they were talking about how Greece was going to default and there was going to be a trade war with China. So this is 2010, 2011. And therefore the dollar had to do this, and the euro was going to do this, and the euro was going to collapse. And I remember I would be selling. I'd be selling on the smallest kind of signs of selling on my day trading. It would go up. And so and meanwhile, I was following the trader who eventually trained me. I was following his stuff, and he was just the news. He was ignoring it because it's lagging. When they get the data for non-farm payrolls, or they get the jobs data, that comes like weeks after what the market's already acting in real time, and the data is lagging. So the market, for example, they say, oh, well, you know, this happened, jobs lost, the jobs gained, but the companies are growing. And so when we look at the market, it's happening in real time. And it took me a whole year. I was following the guy for a year, and he was consistently predicting where the market was likely to go. And I couldn't let go. I couldn't accept that what I was hearing on the news wasn't going to unfold in the markets. Just like today, you'll be hearing about inverted bond rates and yields, and you know, this has got to happen, and a recession is guaranteed, and all these crazy things. And then the market just keeps going. And then 6 months from now, or 2 years from now, 5 years from now, there'll be a market correction, and they'll be like, see, I told you it was going to happen. So that exists. It always exists. It always exists. If you go back 5 years ago, no matter what the market was doing, there were going to be naysayers. So it's much better for us to just trust that the market are actual orders going through. These are physical orders being placed in the market, causing the market to move. So these are actual orders as opposed to what we think the market should be doing. And yeah, we can see, if we look, we can see, let me change my colors a bit. We could see we have, this is on a monthly time frame, very nice bullish candle here. We have a low, a higher low, a higher high, and also currently a very bullish candle. So not only is the market trending higher, coming up to these all-time highs, but it looks great. It's above the moving averages, looks fantastic. So we go to the weekly. What is the weekly doing? The weekly is also in an uptrend. So the weekly is also in an uptrend. We broke through a level of resistance here. It's not really there, it was kind of there. We broke through that. You can see it over here. The market has managed to break through a level. We can see that it's probably going to work its way up to all-time highs, which is up here. Is it going to go all the way there immediately? Come down a bit first, maybe come back to this level and then carry on? That we have to see. I think there's a good chance it could just try and just go straight up there. So, and how do we read the MACD? We do not use in the city. When I traded in the city, we don't use oversold, overbought. It's not reliable enough. I want an indicator that is going to give me a sort of an 80 to 90% reliability, not a 60-40. That's not high enough. So oversold and overbought is not the best way to use these. You can use histogram divergence, you can all these different things, but the best way is convergence and divergence. So if you don't know what that is, it's very straightforward. This is a momentum indicator. So if you are seeing price here, price over time, this is speed over time. So if the market is moving up at a very consistent rate, the MACD will trend up at the same rate. So when you're seeing that higher and that trending higher, the market is bullish. This gives you bullish sentiment. So for example, here you can see this is trending up. It's trending up. And I'm looking at this because I'm looking only at this data. So right now, the MACD is bullish, price is bullish. It is matching it. And so when it's matching it, price is bullish and that's bullish, the market is bullish. Price is trending higher and the MACD has started to trend lower, then you have what we call, and what that means is that this now is not as bullish as it was here. Okay, so it's become bearish, but very importantly, this is not a signal to sell. It's not a signal to sell. It is simply, it's not a red light, it's an amber light. It's saying, look, just be cautious, the market is, or this trend is becoming a bit exhausted. So let me show you this. Let's go look at, where did I see this lately? Gold. Gold's pretty good for this. Okay, so I'm just going to move away. Okay, so for example, just widen this, you can see these. I've got two here. The reason I've got two is because if I see that same divergence on both indicators, it's a confirmation. So we have a downtrend here. So forget about what happens on the right side of that line. If we look, we can see it's there to there to there, so it's kind of generally blah 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 blah. What's interesting though is as we start to come down into this area, okay, as soon as we get there, we can see the MACD's actually started to produce and the RSI started to trend higher. So imagine we can't see anything on that side of the line, but it's telling me actually the MACD's gone bullish, RSI has also gone bullish. We got a bit of a bullish candle here. Trend is probably going to come to an end. It's probably going to go either sideways or it's going to change direction. We don't know which one. We don't know which one. So it can either, once price changes trend, or it can tell us to potentially not sell anymore. So it's a really reliable indicator when we start to look at certain markets. So if we go ahead, let's look at the NASDAQ, let's bring that in, let's go to the daily, and let's look at this. First of all, ladies and gentlemen, this is perfect trend. Does that mean it can't come to an end? Of course not. But what do we see here? Well, let's have a look. First of all, I would say it appears as though we could see we're kind of generally producing higher highs here, but also appears as though we've got a little bit of divergence here. Okay, let's see if we've got anything here. Not so much there. So what does it mean? Does it mean it definitely is now going to, like, Don't let the conspiracy theory come in. It's going to drop and we're going to go into a recession. Not really like that. The first thing we assume is that the week may be a bit overextended, the higher time frame. Extended, and we need to have a correction there. So we're going to look at the weekly. And what it most likely means is usually we come back to the moving averages, We haven't connected with the moving averages in a while. So potentially it means that if the daily went into a downtrend, it would be a weekly retracement. Just so you know, to go from this point here, where we were still in a bull market, from this point, technically we were still in a bull market, okay, to a confirmed bear market. That whole period was about anywhere from 6 to 18 months. So to go from here to there is about 6 to 18 months. It takes a very long time to go from a bull market to a bear market. And again, even here, turning around, look at the bullish MACD and the bullish RSI, and you can see. So then it had to change trend. So to go from where we were in a downtrend at this point to turn around and become an uptrend at that point took a while. 3 months, 3-4 months, takes a very long time. So you can't, and we've just got into a bull market, and bull markets last longer than bear markets. So just logically, it's unlikely that we're going to go back into a bear market now. And the news, and I can tell you this because I've been doing this for 15 years, at least, if not more. I came out of the 2007-2009 global financial crisis, and the stuff in the media now is the same crap that they were playing back then. And 5 years later, they were still saying it, and then 10 years later, they were still saying it. So it's the same stuff. If you just switched off all your social media for a month and just traded off the technicals, I think you'd be less stressed, because you're trying to reconcile why is the market going up when it should be going down according to the news. That stuff doesn't help you. So you'll find technical traders do not listen to the news. That doesn't mean they're not looking at fundamentals. Doesn't mean you're not really looking at, you know, if you're looking at gold, maybe you are looking at seasonal stuff, or maybe you're looking at technology. It doesn't mean you're not doing that, but it does mean you're not allowing the negative media stuff which gets in your head to just mess with you. So how's this different for day trading? All right, so day trading, let's have a look at this. Because we've got a couple of minutes. If you have any questions, by the way, that you would like me to answer before we wrap up, because I won't keep you minutes past the time. If there's something you want me to have a look at, if there are questions you have, please start sending them in now so that I can get to them. You can put them in the chat box, or you can put them in the questions box. So let's go look at euro dollar. Okay, I'm going to bring it on here. And what's going on? Okay, first of all, what is the trend? This is a weekly chart. So we are in a weekly uptrend. That was a level of resistance. Potentially we're coming back, but we are in an uptrend. Okay, so let's look at the daily. Okay, so the daily is still in an uptrend. We've still got, this is a swing low, there's a swing high, so we're still in an uptrend, and we're at a major level of resistance. Is it guaranteed to go up? No, but the weekly is, the daily is in an uptrend. What I would say is if it turns around here and goes up from here, that would make sense given what we've had a look at. So now I want to compare it. Look at the MACD. Is the MACD bullish or bearish? It's bullish. Okay, so that tells me that. It also tells me we're potentially going to turn around. So what would I need to see? This is the daily. So what would I need to see? Let's just say that it's going to come back up here. I can see that because I can see how prices reacted there. And there's a level here. You can see it as well. So as a day trader, they're going to carry on this week and next week. If it's going to go up there, maybe they're going to be trading opportunities. So what would I need to see? Well, first of all, I need to see my 4-hour go from a downtrend into an uptrend. And potentially I see this. I see the MACD turn bullish, so I see divergence. And then I see a change trend. So let's go down and have a look. Let's see where we are. What's on the 4-hour? So on the 4-hour, we are still in a bit of a downtrend. We're sort of coming in to test this level of resistance. You can see it there. So if this starts producing, that's starting to head up. Remember, that's my potential final target. Look here. See how the 50, the 20, and the 10 are all fanning out. And notice how price goes away from the moving averages and then comes back to the moving averages and goes away, comes back, goes away, comes back, goes away, comes back. And you can't tell. The move could be this long, this long, this long, or this long. You don't always know. And no trader really knows how long it's going to go. Okay, and they don't know, but they just hope you're going to get those nice moves. And think of this as a train station. So this area in between the 10 and the 20 moving averages, just simple exponential, doesn't matter. These moving averages, think of that as a train station. So price, the train comes back into the station, goes away. And so this is a very good location to look for entries. And it works well as support resistance, also possibly Fibonacci levels. Sometimes you go in, you grab a Fibonacci measurement, you move to there, you come back, this area where the 50 fib is and a support resistance level or pivot level. All those are very straightforward things, but the idea, the direction coming from what we're talking about. So I would say that once my 4 hourly has gone into an uptrend, then we're likely to see it attempt to go back up to these highs. It's too early to tell now. I need to see it probably come and break up here. I need to see that. Okay, it's too soon. But if it does break up, that could be my very first entry, and then I can start to look for that. And if that's going to be the case, my 1 hour will start to trend a little bit higher. Right now, it's not trending. So this is the market, and if it's going to go up, it'll start to shake out the sellers, and more buyers will come back in. And so it'll go from not really trending, it'll start trending. So it'll go sort of wobble, 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 and then it'll start to actually trend in this way, and the moving averages will then fan out the correct order, and then I can start looking for those opportunities. I hate being sick. And so it'll start to trend and take off. You can see that already. Look at the divergence here. Lower lows. Look at the MACD's trending higher. RSI is starting to trend higher. These have gone bullish, but there's no change in trend yet. I need to see that happen. So this is really important. So patience and discipline, things. You need to know, excuse me, why you take your trade. I'm taking it because I expect euro dollar could turn around and start going up. And therefore there might be some trading opportunities for me. Now I want to compare it very quickly before we wrap up and go to the questions. Let's look at sterling. Sterling is trending high. In fact, it's a stronger trend than euro dollar. It's a stronger trend. Compare the two. Look at these two here. So when you look at that versus that, the angle is stronger. It's moving a lot faster. Bullish candle already. Euro, the angle's a bit different. It's not really the same. So the sterling is stronger. Why it's stronger doesn't matter. We'll find out 3 months from now. They'll say, oh, the pound has been strengthening on such and such. So it doesn't really matter why. So it's looking good. That's the weekly. The weekly's looking pretty good. So the daily here, we're still potential area of support and resistance. So what does the 4 hourly look like? The 4 hourly is almost in a confirmed uptrend. It's not looking that. I would say again, I'd like it to come back in. See this area here, just a little bit of an area there, come back. That's okay if it doesn't. It could come up here, it might do this, might take off from there, but it's likely to take off from those two areas. Let's go look at that 1 hour. One hour starting to move up. I don't think we're free and clear just yet. I think that 4 hour needs to change direction. You see here what it's trying to do. And again, you could also see in this case, that shift, we had those lower lows and we could see that the MACD started trending higher. So really good indications. This is, in this case, I'm showing you this because I'm saying we were waiting for that euro to retrace on the daily to turn around before it can go off and then start looking for that. And once it starts trending higher, then I can go down to the 5 minutes or the 15 minutes and look for those trading opportunities. But I need the 4 hour going up, I need the 1 hour going up. So there's a lot of logic and reasoning behind it. So I want to say this. I was going to say thank you for watching. Listen, I don't want to go too long. I want to answer any questions that you might have. And again, also, by the way, if there's a topic that you want me to talk about, if there's something you want to know more about, let me know. All right, you've got details here as well. I really recommend you engage on Twitter as well as Instagram is a big one. Obviously, we've got, I say we, there's such a dedicated team. I'm an independent trader. I'm an ambassador to FXGlobe. I love this. I love the company. I love what they're trying to do. And yeah, if there's stuff that you want help with in education and clarity, then just let us know. But in the meantime, I'm going to use these as opportunities to brain dump on the core ideas. And the first one I wanted to wrap up, I'm saying that to wrap up now, that I want you to take away from this today is, how do you feel about trend trading, trading with a trend? Do you already have a fixed strategy? Do you understand the logic? Does it make sense to you? Because trading is a logical, rational, evidence-based activity. It is. It should make sense to you. It shouldn't feel like you're just firing away randomly, hoping the market's going to do what it's going to do. You should go, look, this is trending well. This is a decent entry. And, 7 or 8 out of 10, sorry, 7, let's say 6 out of, or 7 times out of 10, it should go your way. It should make sense because the market follows through on that. There's a lot of big investors out there who trade technically. It isn't all fundamentals. The fundamentals are components of it, but it's a very big market. The technicals and the fundamentals are the same information, just looked at differently. So are there any questions, by the way? Can I just see, are there any questions that have come through? Otherwise, I'm potentially, are there any other questions? But I do hope that you enjoyed this and that you found it instructive and useful. And I apologize. I will try to get better for the next one. Goes in a week. This has been 3 weeks. I don't know what's going on. So, Christina, if there aren't any questions, then I'm going to wrap this up. I really hope it's recorded. And again, ladies and gentlemen, I look forward to seeing you in the next one. Yeah, please connect with us and connect with me as well on any of your preferred social media platform. And it's just become X as of yesterday instead of Twitter. View that. I'm not seeing any messages, so I don't think there are any questions, but I'm going to let you go. But thank you very, very much for your time. I really appreciate it.